Tēnā koutou katoa. Nā mai, haere mai, ko Glenn Barclay toko inga. I'm one of the National Secretaries of the PSA. Welcome to PSA House, to this lunchtime seminar. Just start with health and safety stuff first, which is the toilets are either side of the lifts. Men's this side, women's the far side. If in the event of an earthquake, it's the crouch, cover and hold story, the usual, and then wait until you're advised to leave the building. In the event of a fire, it's down the fire exits either side of the lift, and we gather opposite the building on the other side of Aurora Terrace. So I'd like to welcome you to the seminar, as I said, and we're going to hear from Bill Rosenberg. Bill's the CTU Economist and Policy Director from the Council of Trade Unions and was a member of the Tax Working Group. Max Rashbrooke is a journalist, academic and author of a number of publications on wealth and inequality. Both Bill and Max contributed chapters in the 2016 book on Progressive Thinking, 10 Perspectives on Tax, and there's some copies of that still out there, I think. Encourage you to get one if you can read it if you haven't already. The PSA's got a strong interest in tax, which led us to produce that book a couple of years ago. Tax is really important to us for a couple of reasons. One is that it supplies the revenue for the services that our members deliver across the country, so it's really important that there is a decent revenue stream to enable that to happen effectively. And we also recognise the important role that tax can play in addressing inequality in our society, so we're strongly supportive of measures that do that. The PSA has also welcomed the release of the Tax Working Group report and many of the group's recommendations. Although in many areas we feel it doesn't go far enough, and we think the public needs a considered and mature debate on the key issues it raises, as opposed to the kind of debate that we've been experiencing since the release of the report, which has been pretty one-sided and pretty superficial. But anyway, we'll get some light cast on all of that this afternoon. So the format is that Bill is going to do a presentation, and then Max is going to do a response to bring out and stimulate discussion, and then people will be free to answer questions, and the two gentlemen themselves will manage that process. So I'll hand over to you both.
Can I ask a question? What are the time frames around how long is the presentation going to be, how long is the part of all the response?
Well, I've been asked to speak for 20 to 25 minutes, and then Max for 10 minutes, I think. Thanks. But people remind me if I'm going on too long. So, thank you very much, and thanks for asking me to speak here. So I'm going to talk about some of the things that came out of the Tax Working Group report and some things I guess I learned from it. And so I'll be looking at, for a start, at New Zealand's problem of continuing in high levels of inequality, because I think that's an important framing to the whole thing. And I'll look at a number of specific areas of recommendation that have been reported very much, mainly environmental, just a little bit on business taxes, skip savings for now, but if anything I skip you want to come back to later, I'm very happy to talk about them. Personal income tax, understanding high wealth and income, stopping cheating, and then just an introduction to capital taxing income from capital gains. Again, there's a lot of detail there that I won't go into, but again, I can talk about that if people are interested. So, the Tax Working Group itself, as you're probably aware, was chaired by Michael Cullen, former Minister of Finance, etc. And there were 10 other members, 6 of them tax experts or accountants, lawyers, one academic, a consultant, and there was a Chief Executive of Business New Zealand, Māori businesswoman, and an ecological economist and myself. The terms of reference were to examine further improvements in the structure, fairness and balance of the tax system, so a strong emphasis there on fairness. And we weren't allowed to look at a number of things. Increase in any income tax or the rate of GST, an inheritance tax, any other changes that would apply to the taxation of the family home or the land underneath it, and the adequacy of the personal tax system and its interaction with the transfer system, which was left to the Welfare Expert Advisory Group, which has reported back to, we've yet to see its final report made public. There was a secretariat there from the IRD and from Treasury, and we had an independent expert advisor, Andrea Blake. We reported back on the 1st of February, and the report was released officially on the 21st of February. So let's look at the problem of high and continuing inequality. So there are three main ways that that the tax system supports the well-being of New Zealanders. Firstly, it's to collect revenue, and Glenn has already talked about that. There's a number of aspects to that. That's the way that we share as a society, a very important way we share as a society. Secondly, it's a means of redistribution of our income, and a powerful way to reduce inequality. And thirdly, it can be a policy instrument to influence behaviours, and you can see that in areas like health, and in the environment. And we'll look at examples of all of these. So inequality in New Zealand. Now, some of you may be familiar with this graph or something like it. This shows the Gini coefficient, a measure of inequality, both before and after housing costs since 1982. And what distinguishes this, I don't want to go into great detail, is that very sharp rise from the mid-80s to the mid-90s, peaking around 2000. We can discuss whether or not it went up after that. Some people say it's more or less level. I think that's particularly after housing costs it's risen. But the key take home for me here is that we have not dealt with that huge rise in inequality that occurred in the mid-80s to the mid-90s, and to some extent has kept rising ever since. There was a dip in the mid to late 2000s with things like working for families, accommodation supplement, but it got nowhere near actually addressing that very steep rise in inequality, which has put us basically into the most unequal part of the OECD. There's us over on the right, and the third most equal part of the OECD. So there are two main ways that the state can help reduce income inequality, other than addressing it through the industrial relations system, and many of you are involved in doing that. But once we've got our pay in our pockets, or interest from investments and that kind of thing, there's two main ways that the state can help. One is through the tax system, and one is through the so-called transfer system, as Economist put it, or the income support and benefit system. So this is how the tax system reduces inequality. And I apologise for the very small print here, but I hope that you can get the general message. There's New Zealand with the red bar right at the bottom, and this shows the percentage reduction in the Gini coefficient achieved on average by our tax systems. And what you can see there is that New Zealand's tax system is one of the least effective in reducing inequality. Sixth from the bottom there. People then, tax experts then say, oh, well, actually the job is the transfer system. That should be doing the heavy lifting. People who look after transfer systems say, oh, no, it's the job of the tax system really to do the heavy lifting. We get caught in between. But so let's see what the transfer system is doing. Well, once again, New Zealand is right there near the bottom in the effectiveness of its transfer system and reducing inequality. And if you put the two together, well, you can guess what the answer is. And New Zealand is, whether you look at the tax system or transfer system, or the two together, we've got a very weak system for reducing inequality. So both our tax system and our transfer system need work if we are going to be serious about reducing that inequality that grew in the 80s and 90s. And indeed, it's got weaker even over that time in reducing inequality. So Brian Perry in MSD says the inequality reducing power of the tax and transfer system on market income inequality has steadily declined for New Zealand from 27% to 17% over the last 3 decades, 1985 to 2015. And researcher Matt Nolan has come up with a similar or complementary result that the tax and transfer changes account for nearly 40% of the increase in inequality during 1988 and 2013. So there's a lot of work that needs to be done there if we want to do something about New Zealand's inequality. But that was just the income tax system. If we then look at the GST, which collects among the highest proportion of this kind of tax in our tax system in the OECD. So it's a very important tax in our system. The full line, the sloping down one, is our percentage of the percentage that GST is of income by income decile. So on the left here we have the lowest income families. This is the 10% lowest income households. Over on the right is the 10% highest income households. What you see is that as a percentage of their income, the lowest income households are taxed at the highest rate, and by quite a margin. It's virtually double the rate of the highest income households. And this is because the biggest driver of that is because the high income households can save a lot more than low income households. Obviously, if you save, you don't pay GST on your savings. The other line here is as a proportion of expenditure. And there are arguments about that as representative of the lifetime income of people because they spend all that they earn. Well, that ignores inheritances, which are significant for wealthy households. And I think it's pretty small consolation for somebody who is struggling, new family, trying to pay off a mortgage, etc., or with very high rents. It's very small consolation that maybe one day they'll be rich and all come right. So if you look at GST plus income tax plus ACC levies, in other words, the full tax that a household is likely to confront in general terms, there's a few other bits and pieces, but those are the main ones. The rate of tax on their income looks like this. And what you see is it's almost flat. It actually goes from somewhere around 20% to around 30% over that range, which is a very flat effective tax rate. It's hardly progressive at all. Where we do get progressivity is from the income support system, working for families, various types of benefits. And as we know, even though it looks quite spectacular there, these are relatively small amounts at this end because those are the lowest income households. And so that gives us the progressivity that we do have in our tax system. But if we're thinking about taxes, we have a very weak system for reducing inequality. And it's actually a good place to be rich. New Zealand is a good place to be rich. We have the lowest top tax rate, one of the lowest top tax rates in the OECD, 6th lowest, at 33% top tax rate for income tax. The OECD average is a full 10 percentage points higher than that, 43%. All company tax is credited back on dividends. This is the idea. This is called imputation. I don't know if people have come across this, but basically, if you have shares in a company, you receive dividends. The company has already paid tax on that income that it's earned, but that part of the income that is due on the dividends that they pay out to you gets credited back to you against your personal income effectively. So there is no double taxation on company income, whereas in most other OECD countries, except for Australia, there is actually double taxation on those things. So the effective tax rate on a company income is much higher than New Zealand. And of course, that kind of income tends to be earned overwhelmingly by the higher income households. We have the highest proportion of revenue in the OECD raised from GST, which you saw was quite aggressive, and income from capital gains is untaxed. Therein lies the story. So, in order to reduce inequality, income support would deal with poverty if it was sufficient. It's not sufficient, as we know. There's a lot of work to be done there. Tax is one of the most effective ways, along with stronger unions and collective bargaining, to reduce high income inequality, the concerns that people have about the richest strata of society gathering an increasing proportion of the income and wealth and political influence with it. And taxing capital gains, as proposed by the tax working group, is significantly progressive. And you can see that in terms of the distribution of the types of assets that will be taxed by the proposed tax on the income from the capital gains on those assets. So the lowest decile, this is households by net worth, in other words, the wealth of these households rather than income. The lowest decile households basically have virtually no assets that can be subject to a capital gain. And it's really only when you get up to 8th or 9th decile that there's anything significant there. But what you see is that a full 70% of them are in that top decile. So this is highly progressive in its impact. And in fact, that is a wealthy set of households. In 2014-15, which is where this data comes from, that decile averaged 2.5 million taxable assets per household. So that's excluding the family home, cash deposits, bank deposits, and household durables. And so 2.5 million of those assets, and of course on top of that, you've got the house and so on, that would make them even more.
Does that include farms?
Yes. Excluding the home on it, and but basically farms. Yeah.
So that could account for quite a lot.
Well, it could account for some of it, yeah. But I mean, farmers are, quite a small percentage of the community when you look at it. So I'm not sure that is. I don't know what proportion of that is farm.
And if we're talking about things like farms, if there is a mortgage on the farm, then I assume the farm actually counts the value.
Yeah, these are net values, so they're excluding any mortgage over time debt. So other ways to make the tax system more equality, reduce it, more progressive is to raise top personal income taxes, but that was ruled out in our terms of reference. We can reduce the bottom tax rates or increase the thresholds on the bottom tax rate, income tax rates, which is what the working group suggested, but they make only a very small difference to income inequality. And you can tax land, wealth, GST on financial transactions. None of those were recommended. And inheritance tax is another way of going about this, and again that was ruled out. As designed, the tax on income from capital gains would raise approximately 3.4 billion per year on average in place now. In fact, it would not be introduced until 2021, 22, and would only gradually ramp up. But this just to give you a feeling at the steady state sometime in the future, and steady state is a relative thing because this tends to go up and down a lot because asset values go up and down a lot. But in the long run, it will be approximately 4.2% of revenue, which in current terms will be about $3.4 billion per year. That's a useful sum. It's not chicken feed, but it's actually insufficient when you think about what we need to do all those things that have built up over the last decade and more: eradicating poverty, restoring our housing, our health system, mental health and so on, our education system, build infrastructure, and of course pay public servants. And even less is available to the government if this is a revenue neutral package as the government asks for. If it doesn't succeed, if this capital gains proposal does not succeed, then it seems that high inequality and insufficient revenue will remain for many years a permanent yet avoidable blight on New Zealand society. And even if it does succeed, more is needed to be done. So let me now move to some of those. How are we going for time here? Probably another 5 minutes? Right. So let me quickly go through a few other aspects of this, of the report. So there was a chapter on environmental taxes which includes some quite long-term thinking. I can't go into the detail of it, but the main contribution is that it sets up a framework to assess whether or not a tax is a good way to address environmental issues, because there's other ways to do it, obviously. There's regulation, there's education, those kinds of things. So it looked at what would be the favourable attributes that you want, that would lead you to a tax rather than these other things, what essential qualities are needed of the pollution or whatever the environmental degradation in order to make it suitable to have a tax, and some design principles like addressing Maori rights, the distributional aspects, because many of these taxes actually increase inequality, so you need to mitigate that, and so on. The report assessed 5 taxes, most of which are already kind of on the being worked on one way or another within government. Not all of them, but greenhouse gases obviously is water pollution, water abstraction, solid waste and road transport. And it looked at each of those in terms of whether a tax was a good way to go about it. And suggested in the long run that what called a natural capital enhancement tax, which is a kind of land tax, but based on the idea of the environmental impacts of the use of that land. And looked at that as a long-term possibility. It's really not feasible at the moment because we just don't have the tools to measure that impact. There's quite a lot on business taxes. I won't go into great detail. We ruled out lowering the company tax rate. It had already been lowered and there was no evidence of economic benefits from that. And there's a problem that opens a gap with the top personal tax rate, which is used by the wealthy for tax avoidance. And proposed several changes that will reduce tax on companies to kind of balance the effect of tax income from capital gains, as long as that capital gains proposal is brought in. And supported a digital services tax on multinationals like Facebook and Google, which the government has announced it's going to go ahead with, or at least do the work to address. It made some proposals for personal income tax rates. As I said, it is reduced. It is suggesting that the threshold be raised on the lowest tax rate, so that the next high, so the lowest tax rate is 10.5%, currently on income up to $14,000 per year. Suggests raising that threshold so that more people get benefit of that 10.5%, that disproportionately benefits people on low incomes. It's aimed at people, basically low and middle income people, on the assumption that actually to assist people on the lowest incomes is much better done through the welfare system. The ministers had also asked us to look at getting a lot better information on very high income and wealth, because it's very hard to get in New Zealand. There's just not good data on it. And so the group recommended 4 possible ways of going about that, and I feel hopeful that the government might take at least some of those up. And also much better statistical information about the tax system, which is very weak here in New Zealand. It recommended a number of actions to stop rorting of the tax system, stop cheating. Research that was carried out at the same time was independent of the tax working group, estimated that self-employed underreport their income by average of 20%. If that was remedied, that costs probably around about $1 billion per year, so it's quite a significant dent in the revenue. Number of ways to go about that. talk about the strong support for so-called lifting the corporate veil, which means that if you're limited liability companies, very frequently you get this picture not only in the tax system but in health and safety and employment law and elsewhere, that when a company gets threatened with a prosecution, it just kind of disappears and reappears under another name. So this is about sheeting these things home to directors, and a number of other things there which we can talk about if you're interested. So finally, and I don't really have much time for this, but just talk very briefly about taxing the income from capital gains. A capital gain, as you probably know, is the rise in the price of an asset, and it's a form of income because it leaves the owner more wealthy, just as any other unspent income leaves the recipient more wealthy. It's taxed. The proposal is to tax it in general when the asset is sold. That's on realisation of the asset. That it's not possible for most managed funds when it's taxed on revaluation, on an annual revaluation, and that includes investment funds such as New Zealand funds. Virtually all other OECD countries have had this for years, and it's uncontroversial. In most of those jurisdictions, they argue about rates and that kind of thing, but they just said there's a no-brainer to have a tax on income from capital gains. And one Canadian professor told New Zealand that New Zealand would be joining the modern world tax-wise if we institute this. The main reason for a capital gains tax is fairness. It would reduce income inequality, as I've already described. But there's also what's called a horizontal equity aspect to it, that it's just another form of income, so it's unfair to treat differently. So this example, the way we works in the forestry industry, hard, dangerous work, over the last 5 years he's earned $250,000. He's automatically taxed close to $8,000 per year, over $40,000 over the 5 years. Tracy's a property investor and made $250,000, same amount on the sale of a rental house purchased just over 5 years ago. She pays zero tax. Why are they not taxed the same? It's also used by the wealthy to avoid existing taxes, to convert their income into capital gains where it's untaxed. And there's also the aspect that the share of our income, the country's income, that's going to capital, the owners of capital, is currently rising. The share going to labour, to wages, and salaries is falling. And here you can see that this is the historic picture. It rose to a peak largely because of self-employed disappearing in the 1980s, and has been falling with a small rise here basically ever since. It's self-employed, the lowest year basically since the Second World War, and the beneficiary has been corporate income. And so unless we increase those taxes on corporate, on income from capital, then more and more of the tax will be on wage and salary earners who are receiving a smaller and smaller proportion of the nation's income, which simply sounds both unfair and unsustainable. So that's where I will leave it, and over to Max. Thank you. I'm very happy to answer further questions about this, and there's other material there that I can refer you back to. Thank you.
Right. Well, kia ora koutou. Thanks very much, Bill, for that. Thanks very much to the PSA for an opportunity to respond to what Bill said. I'm just going to try to keep my remarks reasonably brief and just focus on places where I think where we need to keep expanding the discussion beyond what the tax working group has delivered us, which isn't at all the criticism of Bill. The rest of the group, I think, have done excellent work within the terms of reference they were given, but I think there were problems with that term of reference in the first place. Just to really briefly go back to sort of the start of things when we're thinking about taxing wealth or income, that's what we're doing, bringing illumination to you all, hopefully. The basic principle of tax is that people have certain resources, certain personal resources that they enjoy, and a proportion of that is retained in the public sector by the state for certain purposes, and that's because the people have worked to have the resources they have. They've also got them through luck, through their upbringing, talents they were born with, the support of others. Also because it's useful to reduce economic inequality, and because frankly we need to pay for stuff. We need things that you all help deliver. And partly it reduced because the resources that we have in various forms bring us all sorts of benefits in our lives. And particularly in New Zealand, the tax system has mostly been focused on taxing income. And this is in the sense of, for most of you, it could be salary that you get paid week by week. It can be wages, it can be benefits. Income is a flow, it's a stream of something that comes in regularly. And I guess that's the focus of the tax system to some extent, because income is pretty clear, it's pretty obvious, and for most of us, not for the very high income earners, but most people it's pretty clear, it's reasonably easy to tax, and sort of the benefits it brings are pretty clear as well. I mean, we all know what we use our income for. We use it to pay bills, we use it to buy things that improve our lives. We use it to get through day to day, and that's pretty obvious. But wealth also brings a lot of benefits to us, and that's wealth in the sense of the assets we have stored up. And so, I think we need to be thinking about, well, how are we taxing wealth as a distinct kind of resource, a distinct kind of thing that people have that brings benefit to their lives as well as income. And I think it's worth saying at this point that whatever sort of wealth you're dealing with and whatever kind of way you're taxing it, you have to get away from this idea that is often that was sort of brought up in response to the tax working group, that there is some kind of problem with taxing wealth because it's double taxation, end quote. That if people have wealth, they've saved it out of their income, they already pay tax on their income, they shouldn't pay tax again on their wealth. That's quote unquote unfair. But for a start, that's sort of evidently not entirely true, because people gain their wealth through a number of means, not all of which include saving out of income. People may just be given large gifts, inheritances, for example, gifts from their parents, which haven't been taxed in that sense, not immediately. And also there's no, and more fundamentally, there's no principle underlying the tax system that you shouldn't be taxed multiple times on the same dollar. In fact, all tax systems everywhere rely on taxing the same dollar multiple times, probably almost infinite times if you think about it. I mean, if you say the salary that you get, if you're working for a company, well, your company has already paid corporate tax, so that reduces the amount they have available to pay you in salary. So corporate tax effectively lands on your income, so you've already paid corporate tax in effect. You pay income tax on your income, and then when you go to buy stuff, almost everything has GST on it, and in theory, store owner pays the GST, but in practice, they just add the cost of the GST to the purchase price. So you are also effectively paying GST. So just on your basic income, you're taxed 3 times already. And that is just what happens. The principle of the tax system is not, quote, tax everything once. That is just not a principle that exists. The principle is where people have resources that are bringing them benefits in which they have acquired partly through luck or the help of others through the use of public infrastructure, they should pay back into the system in whatever form they enjoy that resource. So there's really good arguments, I think, for taxing wealth. Now there's a number, and that's based on the benefits that it brings. And wealth brings us a huge number of benefits that are distinct or in addition to the benefits that we get from our income. I mean, one, of course, is that wealth generates income, but we typically, in a lot of cases, already do pay tax on that. If you have savings and they earn interest, you pay tax on that interest. So that's sort of covered off. You can also tax the benefits you get from wealth when you sell assets and that of course is the capital gains tax, which is effectively treating that increase in wealth as if it were income, as Bill said. We'll even get into a complex definition of debate about whether that's so. But wealth also has a lot of benefits that are not just about the income that you generate from it, or the benefit you get from when you sell it. Because wealth brings benefits constantly and perpetually. Just owning an asset brings an enormous amount of stability to your life. That's a benefit it constantly generates in your life. You know you have something solid, particularly if it's a house, say. You know you have something durable, something that allows you to plan for the future. You know you have an asset that you can sell if times are tough. You know you have an asset you can borrow against in order to, say, start a business, as a lot of New Zealanders do. It gives you membership of the community. Again, particularly a house does that. Wealth begets wealth in the sense that it accumulates over time in quite a passive way. It gives you a certain kind of status, and it gives you power, particularly in the sense that people who are wealthy are constantly being tapped up by political parties for donations, then that allows them to exert influence in the political system. And these are benefits that people of wealth enjoy every year, every day that they possess that wealth. Therefore, I think there are some good arguments that a capital gains tax by itself is a very inadequate way to capture the benefits that people get from wealth, and is therefore a very inadequate way to tax wealth. So I would argue probably for one of two options. One would be instead to have a direct tax on wealth of the kind that the economist Thomas Piketty proposes, where you simply pay a levy every year that is a proportion of the wealth that you currently hold.
Sort of similar to rates.
Yeah, similar to rates. Yeah, but done at a national level. And what Piketty proposes is that that tax, which would be a very low, you'd be paying, say, 1% of the value of your wealth, would be progressive, actually, so that on larger fortunes they pay a larger levy, say 5% of the value of their fortune, or 10%, so that you're pushing further back against inequality. Very hard to model, just for me off the top of my head, how much money you would raise through that, but there is, back in the envelope sort of stuff, a little bit over $1 trillion in personal household wealth in New Zealand, so even a 1% levy on that would raise $10 billion, so you're immediately talking about much larger sums than a capital gains tax, and you could preserve that $10 billion by having little or no levy on people with small amounts of wealth, and a much higher one on people with greater amounts of wealth. Obviously, there are a number of practical issues with doing this. You have to have assets revalued every year, and a lot of assets are hard to value. Nonetheless, there are a number of countries that do this or have done this kind of tax in recent memory. You also have the question of people who have a lot of wealth but very low income. How do they pay the tax? Simple answer is basically you can defer it until they in fact sell the asset, which you can also do with rates to some extent. So the charge builds up, the IRD sort of holds it in lieu until you're actually able to pay it. So I think there are strong arguments for that, albeit it does have some practical difficulties. If you think the practical difficulties are insuperable, the other option I would go for, which is effectively recommended by a big OECD review of wealth taxation last year, is to have a capital gains tax. I would say one that includes the family home above a certain value. So you sort of say, some of the family home is really an emotional investment. It's an incredibly important social thing. We don't want to put that in the realm of economics. We'll exempt that, but over a certain point, over the value of the average home, say, this really is very profoundly an economic asset. People are making a lot of money from selling the family home, and you should tax that. So if in this scenario you would have a capital gains tax on the family home above a certain value and all other relevant wealth, plus inheritance taxes. And I think there are very strong arguments for that. I can't go into all of them in the time allowed. But essentially inheritance is you have to balance out the very natural desire of people to help members of their family. That's a strong social norm, and that's sort of a liberty argument. You should be free to do that. There's a very strong equality/fairness argument that's profoundly unfair, that some people, and I'm in this boat, get inheritance from their grandparents, which they have obviously not deserved. One cannot, you don't choose your grandparents, you don't choose your parents, you don't work for that. That is profoundly unfair that some people get that and others do not. And so the case for inheritance taxation is very strong, in the sense that you still allow people to give inheritances, but you levy some kind of tax on the people who get them to compensate the people who don't. And so what I would do there is what the British economist Anthony Atkinson calls a lifetime gifts tax. Basically, you tax the person who receives the gifts, not the person who's dying and giving them. If people can receive a certain amount of gifts over their lifetime without paying tax, then over a certain point they pay tax on them, and you would then use that to basically do a kids KiwiSaver for poor children, build up the assets of children who will otherwise never be able to get, will never inherit. So I think we need some combination that goes well beyond sort of where the debate is at the moment around capital gains taxes, because they're fundamentally insufficient on a lot of measures, and my basic plea is to keep our minds open, keep our imagination open as to what can be done in this space. Thank you very much. All right, so we've got 10 to 15 minutes for questions, and not a lot of time, so please do make them questions rather than comments. Yes, woman.
Well, thank you both very much. I thoroughly enjoyed that, especially those areas I was less familiar with. It was just in connection to that question around the role of tax. So obviously the terms of reference restricts in almost, I think, inferring that it wasn't interventionary, obviously because of the welfare expert advisory group, who hopefully will see at some point, addressing that aspect of it. Is that something that was discussed in depth during the working group, that whole interventionary role? And would there not be directions on guidelines going beyond the environmental taxes?
So sorry, I missed the key phrase of what you're asking about. What you're referring to?
Well, the role of tax. So obviously we know that we're addressing inequality is what this is about, and the role of the public sector in supporting interventions, but that doesn't necessarily imply inequality. Now, I know the government is asking IRD to address various things, but there don't seem to be any prioritisation guidelines or aspects of, well, if we are taxing things, whether it's sugar, carbon, emissions trading scheme, whatever, whether there are guidelines about where that's appropriate and how we should expect these tax interventions to be decided on.
Yeah. So the tax working group, as you said, did talk about the role of taxation and included redistribution as one of its roles. But there is a big gap there as to, I mean, you can really only think about the tax and the transfer system as one big whole thing, and there's a bit of a nonsense to set to them separately, so we just have to hope that the Welfare Expert Advisory Group has done some good work there, but we'll wait to see. In terms of all those other taxes, like environmental taxes, as I say, the tax working group thought about a framework when you might use them. I think those are more difficult to put in an overall framework of what are the priorities, because many of those are political decisions as to what are the priorities of society. What value do we put on inequality versus environmental degradation and that kind of thing. It's not an either or, but there are always priorities there about how much revenue the society is willing to pay, and the balance of those different bads versus the different goods that you can get from these actions. So I'm not sure how you would go about that wider question, but
in a way, I mean, I think if you're looking for like a grand unified field theory of taxation, that might be impossible. I think in each area of taxes, wealth taxes, environmental taxes, you can come up with an intervention logic, but I don't know that there's one that will cover all of them. Anyway, we should probably, gentleman behind you.
Yeah, thank you. Interesting presentations. if you had had your way and been able to define the scope of the tax working group, how would that have changed? And were you happy with the, so what things might you have done or come up with differently if you'd been writing the recommendations? And secondly,
If I ruled the world, yeah.
and secondly, can you tell us a little bit about transport taxes and how you and others in the working group felt about that or what they concluded?
Right. So, I mean, I personally felt that we really need to be able to look at whether at raising taxes, because I think our income tax system is just not progressive enough. So we need to think about raising those higher income, higher rates. The absence of, I think, an inheritance tax is so important as a form of wealth tax that is commonly accepted around the world, been dying a bit, but I think there's a wide acceptance of it, and it addresses the issue of the growth of, intergenerational wealth, which is even more unfair than within a lifetime, I think. So I would have liked to have seen much more scope in a lot of those areas where it was simply ruled out. I think also someone had to, I think in some ways it would have been better if the two working groups, the welfare and the tax working group, were one working group, so it could have looked at that whole thing across both systems and get a consistent approach. It would have needed a lot more time because that becomes a very complex process, but we got ourselves into quite a mess here really with the problems of our systems, and needs to be sorted out. Roading, it was largely about congestion charges and that kind of thing. We'll have to think about what we came up with there. It was recognised that there is a need to address the externalities of road use, but also recognised that, like other taxes of this sort, they can be regressive and hurt people on lower incomes. They fall more proportionally on people on lower incomes, so you need to think about those issues at the same time. Sorry, I can't go into that in more detail at this point.
All right. Yes, the gentleman with the hand up.
Max, thanks for your response. I thought it was really great. My question though is for Bill. Obviously we're interested in the content. I have a question about process. What was it really and truly like in the tax working group? Especially what was the quality of the debate like, and were you respected?
We're among friends here.
They were among friends. Just being recorded for broadcast over. It was respectful debate. I mean, I did feel that I and probably Michael Cullen were the ones that who had the issues of inequality and so on foremost, and welfare and well-being. I would say that the group did one thing that I haven't included in that presentation was that, and I thought this was a quite powerful thing, that we tried to use the wellbeing framework, the living standards framework, as one of the criteria for judging what a good taxation system looked like. The classic set of criteria for a taxation system is heavily weighted towards efficiency, economic efficiency. There is mention of equity within it, but tends to be underemphasised, and certainly issues around environmental sustainability and so on are not a big part of it, or are difficult to fit into that framework. And so I think for some people on the working group who were tax experts and used to looking at that very efficiency-oriented framework and simple tax simplification, using that framework, I think, did change their minds as to what a fair system looked like. But it was basically a relatively conservative group of people there, and so I would say that if the government wanted different outcomes, it would have had different terms of reference, and it would have different people on that group. And I think it's just an actual statement.
All right. No questions? Yes. Here.
Thanks very much to you both for speaking. Just one question regarding the scope of it and the outcome. Do you think it's the recommendations? Do you think that small step in recommendations to consider capital gains tax is a huge step, considering the pressback that, politically speaking, you wouldn't have got anywhere if you had tried to expand it further? So in some ways, do you think that the stage we're at now is at a better place for public acceptance than it might have been if we tried to do a broader scope, given the pushback that capital gains tax or any form of enlargement of tax has had before?
I think tax is highly political, obviously, and for perfectly understandable reasons. When people are told that some of their income is going to be taken away from them, then they resist, and that's kind of natural. People are always very happy for someone else to pay higher taxes, but not themselves. So yes, instituting a tax on income from capital gains is a big step, and perhaps you could make the judgment that is, as far as you can go in
right
one change. And from that point of view, while it's not, in the ideal world, I'll be adopting some of the ideas in general terms, at least maybe not precisely discuss the precise design, but in general terms, I'd agree with Max that we ought to be thinking about wealth taxes and land taxes and inheritance tax and so on. But to do all those in one go is politically probably not feasible. And what we're dealt with at the moment is this possibility of a reasonably good and effective capital tax on income and capital gains. And it is highly progressive, so it is a significant step forward in terms of reducing inequality and improving that horizontal equity of the way people are taxed. And so my feeling is, if it's on the table, we should grab it and support it. But keep on working for more change. Yeah.
And it's worth saying that, in a lot of countries where there are capital gains taxes or something like that, they're often flat rates to some extent. So what the working group has proposed is, within the frame of capital gains tax, actually quite progressive, because it said, you should tax it at the same rate as income is taxed. I think it's also worth remembering that UMR did some polling for the CTU. In fact, I think that said, if you say to people really explicitly, do you support a capital gains tax on assets excluding the family home? Think about, from memory, 57% of people said, yes, I do support that. I suspect if you included the family home, it would drop to some very low number, which is why that's such a big political trade-off. Despite the enormous backlash and the vacuum in communications that was left by the other side, there is at least a significant proportion of the population who are willing to be persuaded about a CGT. I think it's important to keep that in mind. One more question. Yeah, gentleman at the back had his hand up for a while.
Hello. I was just wondering, immigration. We're talking about immigration in New Zealand, and I think I've always wondered that they come into New Zealand, it's a first world country before it, but yet there's no immigration tax, no levies. They come in here, people from around the world come to New Zealand, and there doesn't appear to be any sort of using the services, and there should be some sort of levy put on as a way of getting tax.
Well, if people immigrate to New Zealand and work here, which, when we talk about immigration, we're generally talking about people coming here to work either as a household or individually, then we'll be taxing them obviously because they're simply, they're getting income and they get taxed on it. I think your argument is more valid in the case of visitors here who, tourists and so on. the government is currently thinking about, well, I'm not sure how far it's got on designing a visitor tax. I think it's $25 for every visitor or something like that. Some argue you could tax it, make that rate much higher. I mean, I think there is a good argument for that, you know, they're coming in and they are using New Zealand resources. We have very obvious problems in coping with that number of visitors in various places, and many local authorities are crying out for more resources, and conservation departments and so on. So I think there's a strong argument there. In terms of immigration, yeah, I think that is actually just covered by our normal tax structure, and probably don't need anything particular different.
Sorry, I'm just quite conscious of time. Sorry,